Hi everyone, warm welcome to our masterclass on ratio analysis today. Let me start with a brief intro of mine. My name is Anshul Agarwal. I hold close to 15 years of industry experience. I worked in various industries such as IT industry, finance industry and education industry. I started my professional career with TCS in the IT domain where I worked on various automation projects. Then I moved into finance field where I worked in the investment banking division of Citicorp, and also I worked with Valuation in their investment banking division, and then I moved into education industry. So, uh, carrying on from my experience in the investment banking industry, I'm going to talk about a very important topic today, which is ratio analysis. So, let's first start with the introduction of the topic. Ratio analysis is a technique used to do financial analysis, right? So, any financial analysis you see, you will definitely look at different types of ratios. And I can say that no financial analysis is complete without doing a proper ratio analysis. Um, what is a ratio? We can look at absolute numbers and we can look at comparison of numbers. So when we say ratio, it is nothing but a comparison of one number with another number. How it helps us? Uh, yeah, it gives deeper insights than absolute numbers. Let's understand this better. So uh, let's say I'm looking at the numbers of Infosys. So I'm looking at the latest available annual report of Infosys, and I move to its consolidated statements. So we have three financial statements: balance sheet, income statement, and cash flow statement. And right now we are looking at the consolidated balance sheet number of Infosys for the financial year ending 2024 and 2023. Right now, if we look at this balance sheet data, we will see that it has the data related to assets, liabilities, and shareholders equity. But what we are looking at here is the absolute numbers. So that means I can see that property, plant, equipment was 12,370 crores, whereas last year it was 13,346 crores. Similarly, um, if we look at equities and liabilities, we are again looking at absolute numbers for the 2 years. Here is the profit and loss statement, which is telling us about the revenues generated by the company in this financial year as compared to the last financial year, and what were the expenses and what was the profit. So what we can see here is, from the absolute numbers, I can figure out that company generated more revenue from operations, yeah, as compared to 146,000 odd crores to 153,000 crores, and the profits also increased from 24,000 to 26,000. Right. So again, looking at these numbers, I can easily figure out that the profits have increased. But just by looking at absolute number, can I figure out uh, why have the profits increased? Is it only because of increase in revenue, or is it also because of operational efficiency, or is it because of relatively lesser increase in expenses? Right. So uh, that becomes difficult when we look at absolute numbers only, and that is where ratio analysis comes in. For example, if I compare this number with revenue, then I'll be able to figure out the profit with respect to the revenue. That means what was the margin, net profit margin. So this is one of the ratios, right? So then if the net profit margin has increased, then we can say that it is not only because of increase in revenue, but the profit has also increased because of lower increase in expenses, right? So this is where ratios come in. Let's look at one more example. Let's say we have very simple data of two companies, company A and company B. Company A generated revenues of $1,000 million and company B generated revenue of $600 million. Company A had a EBIT of $100 million, whereas company B had a EBIT of $90 million. So looking at just the absolute numbers, we can see that EBIT of company A is higher, right? But can I say that company A is doing better? Not really, because if I look at the EBIT generated by the company with respect to the revenue, it is 10%. Yeah. Whereas for company B, it is 15%. So on a relatively lower revenue base, still the company B is able to generate 90 crores of EBIT. So operationally, I can say that company B is doing better than company A. And that becomes clear when we look at a particular ratio. In this case, we are looking at EBIT upon revenue ratio, which is known as EBIT margin ratio. So from the ratio, we figured out that company B is more operationally efficient as compared to company A. So that's why we say that ratios gives us deeper insights about the financial data than absolute numbers. Also, ratios allow us to comparison of numbers across companies and sectors. Again, coming back to example, let's say I look at numbers of Infosys. Okay, I'm back to this annual report where we are seeing the consolidated financial data of Infosys in the year 2024. They have generated a profit of 26,248 crore. Now, if I look at one more company, similar company, let's say I look at TCS. And I look at the consolidated financial data of So I'm looking at consolidated financial data of TCS now, and let me go to the income statement. Here I can see that TCS has generated a profit of 46,000, almost 46,100 crore, right, for the year ending 2024. So now, if you look at just the absolute numbers, you will see that almost all the numbers of TCS are larger than Infosys, correct? So the profits also generated by them is higher than the profit generated by Infosys. But just based on these absolute numbers, which will all look higher for TCS as compared to Infosys, can we say that TCS has done better? Definitely they have generated more profits, but operationally how they have done it as compared to Infosys. So what we'll do, again, we'll look at different ratios of Infosys. In this case, we want to compare the profitability. So we'll look at various profit margins of Infosys versus profit margins of TCS. And then we'll be able to figure out which of these two companies has done better operationally. So what we are trying to say here is that just looking at absolute numbers does not give us a complete picture. We need to look at ratios to not only analyze the data of one company, but for any comparison of companies in the same sector or across years, we need to do ratio analysis to do a proper financial analysis. So, and as a financial analyst, it is very important that we are very clear about ratio analysis and comfortable with this topic to become a good financial analyst. Now, who are the audience for this data for different types of ratios? Who looks at, uh, who wants to look at different types of ratios? Uh, there are multiple audience. For example, potential or existing investors. If I have invested in any company, or I am planning to analyze and invest in any company, I'll definitely look at various ratios the company is able to generate as compared to other similar companies, and then I'll figure out whether it is a good investment or not. Similarly, creditors, lenders want to look at ratios. They want to see before giving loan to any company. For example, a bank is planning to provide loans to um, Tata Motors or Infosys. So before giving any loan to these companies, they would definitely need to figure out what is the ability of the company to pay back, right? So accordingly they will decide on the amount of loan and other terms and conditions of the loan. So our creditors like banks, NBFCs, uh, our lenders, those would need to look at these ratios also before lending any credit. Similarly, management team. Let's say we are sitting in the top management position of any company, in the leadership position. So we need to figure out how our company is doing. So for that also, we will need to look at various ratios which our company is generating, and then we can figure out whether uh, from last 5 years we have done relatively better, or we are doing uh, not so good. So for analysis of our own company also, the management team would definitely be looking at various ratios. Then government, customers, competitors, these are also relevant audience for looking at various financial data and ratios for the companies. Ratio analysis can be used in two ways. So one is time series analysis or trend analysis, and the other one is cross-sectional analysis. What is time series analysis? In this, we do the comparison of the financial performance of a single company over different time periods. So let's say I am looking at Infosys, and I want to figure out how Infosys was doing earlier versus how it is doing now. So what I'll do is I'll do a trend analysis of Infosys, right? So for example, in time series or trend analysis, we will look at a single company over multiple periods. For example, let's say I'm talking about company Alpha. So company Alpha generated EBIT margin of 20% in FY 2020, and let's say this is the EBITDA margin of uh, company Alpha over a period of last 5 years. Similarly, let's say their ROE was, and let's say their debt to equity was this much. Right. So now this is what we do in time series analysis or trend analysis. We look at a single company over multiple years to figure out how the company is doing now uh, versus historically, how the company has done. So if I see here, I can figure out that EBITDA margin of the companies have improved over a period of last 5 years. Uh, Today it stands at 24% versus 20% 5 years back. So I can say that the company is becoming more operationally efficient, right? They are able to generate more EBITDA by reducing operational costs. Uh, Return on equity has increased from 16% to 21%, which is also a good sign. Return on equity is how the company is able to generate profits or returns using shareholders' funds, shareholders' equity. So they are able to generate better returns over the periods. That means their ability to generate returns has increased over a period of 5 years, and their debt to equity ratio, which was 1.3x in FY 2020, has reduced to 0.9x in FY 2024. So we can say that their debt in their capital structure includes debt and equity. In their capital structure, debt proportion has reduced as compared to equity. So they are relying less on debt now as compared to what they were doing 5 years back. So again, through ratios, we are able to compare the financial performance of the company over multiple years, and this is what we call as time series analysis. Second is cross-sectional analysis, in which we do comparison of the financial performance of different companies for a particular period. For example, comparing the financial performance of Infosys, TCS, Wipro for FY 2024. So what we do in cross-sectional analysis is we look at multiple companies now. In time series analysis, we were looking at just one company, but here we are looking at multiple companies over a particular period, right? So how different companies have done in that period, that is what we do through cross-sectional analysis. For example, let's say here we have okay. So what we have done here is we are looking at data of different companies for the year FY 2024, and we can now compare these companies. Company Alpha has a EBITDA margin of 24 as compared to company Beta, which has a EBITDA margin of 21, as compared to company Delta, which has a EBITDA margin of 22. So if these are similar companies, let's say they are in a particular same sector, then we can say within this sector, company Alpha has done better in terms of EBITDA margins. So they have performed more operationally efficient. They were able to control the costs better as compared to other companies. Similarly, ROE is better for Alpha, and debt to equity ratio is also lower for Alpha, which is a good sign. So what we are trying to do here is we are trying to compare the different companies for a particular period. This we can do through cross-sectional analysis. So these are the two ways we can broadly use ratio analysis. And yes, this is the brief intro about the topic, which is our ratio analysis.